Hello friends, before I begin this video, may I request a few seconds of your time? No, it's not what you think it is, but it's as important. You see, those of you who've been connected with me for long enough have given me a lot of love and affection and have appreciated my work on television interviews, print and electronic media articles, etc. And you know me as a pure prop trader, which I have been doing since 1986. So you see, we focus on doing things, which is why we have zero idea about digital marketing, about advertising, or how to reach our work across to a bigger segment of the audience. But we want to keep our work free. And just because it's free, it doesn't mean it should not reach out to a whole lot of people. Can we depend on you to give us the word of mouth and other push, like sharing our work with your social media platforms, with your social media groups, etc., so that we can reach out to a wider audience and spread the virtue of knowledge? If you can do that, it would be absolutely great for us. Now, let's dive right into the video. Hello friends. Last week in my video, I explained to you how the financial sector stocks were dragging the rally and basically slowing down the up move. I also showed you how the Bank Nifty was underperforming the Nifty 50 over a 12, 20 and 4-week period. Well, last week, the Bank Nifty happened to play catch up and basically perked up higher than the Nifty 50. Now, the Nifty is approaching the previous all-time high, and what we need to see in this video is what stocks will propel this rally higher. Because the stars of the rally so far have been public sector units or PSUs. And I've been advocating these stocks since many months in my videos. As a matter of fact, I've recorded a video last year about why I prefer trading public sector units for a good above average profits. The hyperlink to that video is in the description and in the pinned comment below. Now, can PSUs alone take the markets to a new all-time high? Knowing me, you would want me to share statistical weight of evidence, and in this video, I want to analyze what this weight of evidence is suggesting. Now, take a look at the PSU stocks weightages in the Nifty 50. What you are seeing is that the total of these 7 stocks has a cumulative weightage of 8.59% in the Nifty, which means that these stocks are put together commanding a lower weightage than Reliance Industries alone. We are not even talking about HDFC Bank. Now, these stocks have an average beta, which is pure price volatility, of 0.92 vis-a-vis the Nifty 50, which means that these counters are less volatile compared to the Nifty, and it makes them more suitable for buy and hold type of traders and investors. The average monthly return has been 7.35%, which is far above average returns given by any other sector or segment in the market. But the weightage in the Nifty being low, it means that some other stocks will have to contribute their might in order to take the broader markets higher. Now let's see the weightage data as you can see on your screen right now. Now this screen basically shows you the sector-wise weightages in the Nifty 50. You know, I've been talking about the financial sector services very often because the weightage is quite simply the highest in the Nifty. At 33%, this is a swing sector. So banking and financial sector, whichever way it goes, it tends to pull the Nifty higher or drag it lower. The information technology is a very distant second. The weightage is less than half of the financial sector services. Oil and gas is a third. Remember how HPCL, BPCL and IOC have been blazing the charts over the last couple of trading sessions. And in my last week's video, I shared a hyperlink to more than half a dozen stocks which had a very high concentration of market-wide position limits, or MWPL. And note how oil marketing companies were in that list. Obviously, there are some others: FMCG, auto and automobile components, construction, healthcare, etc. Now, what we need to see is whether the heaviest weighted counters in these sectors itself. Now, when you do a sum of the parts, or SOTP, and see that the heaviest weighted stocks from these sectors, if they are to rally, obviously the Nifty will push and surge even higher. Technologically savvy traders will take less than 3 minutes to arrive at the SOTP metrics, which is the sum of the part metrics, and even be able to guesstimate the approximate move that the Nifty can make after these stocks move by what percentage points. Now, the last screen on this study is the top 10 heaviest weighted stocks in the Nifty 50. As you can see, HDFC Bank is still leading the charts. Second is Reliance Industry, and these cumulative stocks put together take the Nifty with themselves. So whichever way these counters move, the Nifty tends to basically go in the same direction. So if I were you, I would basically watch these counters very, very carefully, and I would also zero in on where the action is. Now, for me, the action is in price, volume, and open interest. So what I would look at is statistical beta, which is the pure price volatility. Then I would see the traded turnover and the volumes. And third, I would watch is MWPL, or market wide position limits. Though I've shared videos in the past where I've told you why MWPL is such an important tool for you to understand and master. So friends, we've seen how this list of 10 stocks plus the industry leaders amongst these sectors that are the most heavily weighted in the Nifty need to move before you can say that a new all-time high is coming. Now, this study done, I've shared the names of the stocks with you. I revert back to my original format, and on your screen right now is the weekly market roundup window. What you can see is that the Bank Nifty gained more than the Nifty 50 and the US dollar index continued to rally. Now, since the US dollar continued to rally, commodity prices eased, and natural gas prices basically collapsed. It's not just a price decline, it is also the negative cost of carry or backwardation in the February series as compared to the higher prices in Jan. Do remember what I've been telling you, gas prices tend to be high in winter and they back off in the summer. So 5-month futures invariably tend to have backwardation in them. The USD INR, which is the US dollar versus the rupee, fell, which means the Indian rupee actually gained against the dollar in spite of the US dollar basically being strong, and that boosted our equity markets higher. The NSE market capitalization went up by 3.18%, which tells you that the rally was fairly broad-based, and the market-wide position limits itself continued to rise routinely post-expiry. The US stock indices moved up uniformly. All three leading benchmark indices went up, and that provided tailwinds to the domestic markets. Friends, I now come to the MWPL, which is the market-wide position limits. This is the percentage of exposure utilized by trader as a total component of what is allowed by SEBI. What you're seeing is a routine rise after the expiry. Every 4 weeks on expiry, the MWPL plunges downwards. That's a part and parcel of the rollover process. Now, post expiry, we are at 33.86%. which is the lowest after the November derivative series expiry, which means the check writers were cautious last week. I will suggest that we continue to monitor the MWPL, both of the overall market, which this chart represents. I put up this figure every day on my free social media accounts. Do connect with me there, especially on my Telegram channel. My contact coordinates come at the fag end of this video. It's a free channel. All my thoughts, research and trading game plan I share only on my Telegram. So I will continue to monitor the MWPL of individual stocks as well, especially the index heavyweights and sector leaders in the sum of the parts or SOTP metrics, which I discussed earlier. That will tell you instantly if risk appetite is growing or not. Friends, I now come to the index and stock futures turnover. This is concurrent 3 series, that is February, March and April. And sure enough, there was a routine fall post expiry rise, because on expiry day, what you are seeing is people closing their positions in the expiring month and reinitiating their exposure in the next month. That results in double turnover. So there's been a routine fall post expiry, and stock futures fall has been a lot more pronounced as compared to index futures. And stock futures are more volatile, demand more capital by way of span margin and mark-to-market margins. So it seems risk appetite was marginally, just marginally lower. Friends, I now come to the advanced decline ratio, which is a leading indicator after the price itself. Even though the Nifty logged bigger gains on a week-on-week basis, the advanced decline ratio fell a little to 1.23, which means for every 100 losers, there were just 123 gainers as compared to 136 gainers in the prior week. Clearly, intraday traders were showing signs of caution. Friends, I now come to the prompt month futures basis. Now, basis is nothing but the premium or discount prevalent in the futures compared to spot. Exactly like options premium, as expiry approaches closure, the basis also tends to contract, which is why last week I told you that these lofty period high bases of 426 on the Bank Nifty and 136 rupees on the Nifty 50 could not last. 2 reasons why the basis fell. A, time decay. B, lower risk appetite at higher levels. So this is another indicator that risk appetite was somewhat guarded in the week gone by. Now, friends, I come to our first in-house exclusive indicator you won't find anywhere on the internet. You've been supporting and liking this indicator for over 3 years now. Now, what you're seeing is that the Nifty and Bank Nifty both gained, but impetus on both these indices fell, which means on a net basis, even though the price seems to have gained, the momentum behind the gain was fairly poor. I would have wanted the price and the impetus readings to go up together in tandem simultaneously, but that is not the case. This is a mild concern. Am I saying that it's going to be a bearish week ahead? No, I'm not saying that. All I'm saying is that I wish the bulls had bought a lot more aggressively. If they do that in the coming week, all is well, the markets can rally, failing which you could see some consolidation at higher levels. I now come to our second exclusive indicator, in-house indicator, the lift, weight, thrust, drag indicator, which again I share on a daily basis on our free Telegram channel. Do connect with me there. And this weekly chart tells you that in spite of the higher gains made by the Nifty last week, the LWTD reading has fallen a bit. What does it tell you? There is a video I have made on how to interpret this indicator. The hyperlink to that video is in the description and in the pinned comment below. So what the interpretation of this lower LWTD reading shows is that at higher levels, fresh buying support may be a little milder as compared to what we saw last week. all in all, I would say that so far, whatever weight of evidence we've seen, whether it is the advanced decline ratio, whether it is the MWPL, whether it is the impetus, whether it is the basis in the futures, and now the LWTD, there appears to be some sign of caution here, which makes it all the more important for those 10 index heavyweight stocks to rise, as well as the industry leaders from those heavyweight sectors to rise, if at all you want the Nifty to make an all-time high and go past it. Friends, our exclusive in-house indicators done. I now come to the bond market, which is very close to my heart, and I have been at the forefront ahead of our contemporaries in tracking the bond market, even ahead of the equity markets, because this market funds all other asset classes. This is the fountainhead of money supply. What you are seeing is the Indian bond yields are now at their lowest after July 2023. Now, since bond yields are lower, it means bond prices are higher. Who buys the most amount of bonds? Hey, banks are the biggest investors in bonds. And now that bond prices are higher, there's a mark-to-market gain in their bond portfolios. And therefore, there's a notional unbooked profit in the books of banking stocks, which is why Bank Nifty rose more than the Nifty 50. If somebody was to tell you that you should be ignoring the Indian 10-year benchmark bond yield and you should be ignoring the bond market and trade the banking stocks, especially the Bank Nifty, without tracking the bond market, I said, hey, you're doing this at your own risk. You can't ignore the bond market and trade banking stocks and the Bank Nifty. Now, what is the result of this significant fall? This fall in Indian 10-year benchmark bond yields is one of the biggest in many quarters. The gilt fund portfolio that I recommended to you on 14th of December, as soon as the US Federal Reserve failed to raise interest rates and gave a fairly dovish kind of a guidance, the portfolio of all the 4 gilt funds has jumped significantly. What you are seeing is a gain of anything between 1.29% to 2.69% in 6 weeks time frame. Try getting that from the debt market, from the fixed income market, from any other place. Find out for yourself if you're getting this advice, and that too for free, like I'm sharing with you on our YouTube videos and Telegram channel. Also note how the 1-year returns are in lockstep, in descending order, as I recommended these gilt funds to you originally on the 14th of December 2023. So that speaks volumes about the statistical research that we put into our statistical trading model, the IBEX, which basically gives us recommendation across all asset classes, derivatives, currencies, commodities, bond markets, and we basically are upgrading it all the time. Now, here is also another graphic that I'm sharing with you, the interest rate sensitives. What you're seeing is, even though the Bank Nifty jumped last week, I told you part of the reason was the rise in bond prices, therefore the fall in bond yields. It could be a relief rally at this point in time because the Bank Nifty and interest rate sensitives, I call them IRS stocks, interest rate sensitive, still remain underperformers as compared to the Nifty 50. So I would still want the financial sector services stocks to rise significantly. Remember, the sector has a weightage of 33%. Find out the leading stocks from this sector. You'll basically have an instant metrics ready on your SOTP or sum of the part trading model itself in under 3 minutes. So here again, friends, what I'm sharing with you on the screen now is the returns of the Bank Nifty being lower over a 4-week, 12-week and 20-week time frame. You were better off putting your money in a savings bank account rather than buying and holding Bank Nifty futures. By the way, this return does not include rollover charges, brokerages, and other execution costs, taxes, etc. In which case, if you were to add those, your returns would be even more negative. So I want financial sector services stocks to perk up, pull up their socks, and rise if the Nifty is to rise higher. Friends, the bond market's done. I now come to the Bank Nifty, which gained 2.46% on a week-on-week basis. It rallied on 3 out of 5 trading sessions, and the price has closed above the month-long moving average, which itself is pointed downwards. So this is a good relief rally at this point in time, and the price attempted to rally past the 46,370 level, which I've marked as a red trend line, but it failed to close above it thanks to the fall on Friday. It is of paramount importance that bulls keep the Bank Nifty spot trading above the 46,370 levels if at all the next phase of the up move is to start and the bulls are to regain their advantage. Let's now go to the weekly chart, and what you can see is that the candle, even though being bullish, the body of this candle is still contained within the bearish body of the previous week's candle. And note how there's a long shadow or a wick on the bullish candle above it. That tells you that even though the Bank Nifty scaled higher levels, the closing of the week was significantly off the weekly highs. That means at higher levels, there was skepticism, there were doubts, and there was lack of conviction. The price has closed above the 25-week moving average, which is a proxy for the 6-month-long holding on cost of an average bull. So the medium-term outlook is turning optimistic as of now. We still need to move above this average, and the average needs to move upwards. There have been two throw under patterns on this chart. Throw under is when the price falls below a trend line. There has been one throw over, but if throw unders are getting more and more frequent, I'm afraid it's not really great news for the bulls. Now, the wedge formation formed on the Bank Nifty is basically showing a narrowing range at higher levels. So obviously a breakout in either direction is a given. Just because the ranges are contracting, the Bank Nifty has nowhere but to break out in one direction. It'll be of critical importance to note which direction, with what volumes and what changes in MWPL and banking stocks does this occur. Now, I've already shared with you the lower returns of the Bank Nifty compared to the Nifty 50. So we know that this index has been a little challenging for the bulls. In the week before last, this index was number 2 on our most volatile counters list based on statistical beta rankings that we maintain in-house. It fell 2 notches to number 4. Also because individual stock volatility jumped higher and faster than the Bank Nifty. I've been pointing out in my Live Mint column, which is India's first and only statistical news media column which shares statistical inputs with its readers. I've been sharing with you since a fortnight that I expect volatility to jump higher. And sure enough, individual stocks was more higher than Bank Nifty, so the Bank Nifty's volatility is lower. Last week, I advocated an estimated range between 46,250 on the upside and 43,525 on the downside. Admittedly, the high made at 46,892 was significantly higher than what I kind of expected, and that too by a big wide margin of 642 rupees. That was the extent of volatility, but higher levels could not sustain. In the coming week, I estimate a range between 47,375 on the upside and 44,550 on the downside. Friends, in addition to this range, please also check out our free Telegram channel for daily, weekly and monthly pivots on these indices, which I share for free, and they'll help you whether you're an options or a future trader, intraday or swing. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 2.35% on a week-on-week basis, and exactly like the Bank Nifty itself, it rose on 3 out of 5 trading sessions last week. The price is above the month-long moving average, which itself is pointed higher. So relatively speaking, this index appears to be stronger than the Bank Nifty. Although an inverted hammer on Friday, and that too with the intraday high being near an all-time high, is a mild concern for bulls. It shouldn't have happened that the Nifty rose so much during the day, but surrendered most of its gains by close. That needs watching, especially since it's come at an all-time high and a Fibonacci extension level of 261.8%, which comes at approximately 22,200. Note how I've been advocating 22,200 levels as a resistance since the last 3 to 4 weeks in my videos. We need a breakout above this hurdle if at all the bulls are likely to get back in the driver's seat. The weekly chart on your screen shows a bullish candle with an upper shadow or a wick, but the upper wick is not as big as the Bank Nifty, which means that the caution and concerns over the Nifty 50 is lower compared to the Bank Nifty. The price is significantly higher than the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook remains positive, but the big gap between the price and the average, as I've explained to you earlier, means that there is to be a mean reversion. Either the price consolidates sideways and the average catches up with the price, or the price falls and touches the average and then rises again. Either ways, what we are seeing is that the Nifty 50 is running far faster and ahead of the Bank Nifty, and there is possibility of some amount of profit taking. The 22,200 Fibonacci extension level is marked very clearly. It's more prominently visible here on the weekly chart compared to the daily. So you need to see whether we are able to get over this resistance. On the flip side, I would watch the 21,450 mark, which is the 223.6% Fibonacci extension level, as a sign of support. Now, this was a resistance for at least a fortnight 2 months ago. So now overcome resistance will become a support. We don't want the 21,450 level to be violated on a sustained closing basis. If that happens, the bulls might have to yield or surrender more ground. In the week before last, this index was number 9 on our most volatile counters list based on statistical beta rankings we maintain in-house. It slipped 1 notch to number 10. Last week, I estimated a range between 21,850 on the upside and 20,875 on the downside. The high was at 22,127, which is a good 277 points higher than what I estimated it to be. In the coming week, I estimate a range between 22,350 on the upside and 21,350 on the downside. And here again, please do check out our daily, weekly and monthly pivots on the indices, whether you're an options or a future trader, intraday, swing or buy and hold kind of trades. This is exclusively on our free Telegram channel. Friends, I now come to the last bit of statistical analysis wherein I share the turnover contribution in the 4 segments of the derivatives market. And on your screen right now is a weekly chart of the turnover contribution. The index futures turnover fell 2 basis points. It is shown as a blue line. The stock futures turnover contribution fell by 31 basis points. It's shown as a red line. Now, do note that futures demand more by way of span and mark-to-market margins, and since turnover is falling there, also because the expiry turnover is a higher base, there is a slight degree of risk contraction. Now, where has the turnover risen? The highest rise in turnover is come in index options, which are the least volatile relatively speaking, and they demand the least amount of money, both as in terms of premium for options buyers and in terms of span margins for option writers or sellers. The other turnover gainer was stock options, where 9 basis points increase in turnover was seen, which is shown as a purple line. Now, net, I would say that the risk appetite is lower because people were favoring more in options, less in futures, and that too in the lowest risk index options segment. So I want them to write out bigger checks in futures if at all the markets were to see a new all-time high. Friends, I now come to my own trading strategy and blueprint for the week ahead, which I have been sharing with you for many months every week. Public sector units and public sector banks especially will remain on my radar as they have been since months, and I'll keep them on my gun sights again. With short covering over on metals on commodity exchanges and prices declining in industrial metals, I think metal stock prices might fall a little bit. Some consolidation might be in order. Oil and gas fell at higher levels. They proved to be unsustainable. I have been debunking the bullish super cycle theory since years, and I've posted on my free Telegram channel, the link to which is in the description and in the pinned comment below, about an update in December as to why oil and gas prices might attempt to rally, because Vladimir Putin, the president of Russia, is facing elections in Russia on 17th March 2024, and he will try to weaponize oil and gas exactly like he did in 2021 and 2022 before the Ukraine war. But the rallies will be temporary and they would invite short selling. So high risk appetite traders would resort to theta decay plays in the non-linear derivatives, in out of the money strikes in options. And if at all prices are making outsized gains, you would basically do well to refer to our daily, weekly and monthly pivots, even in the commodity space, on our free Telegram channel. And in that case, in outsized moves, you may want to take a higher risk linear futures shorting decisions, but based only on these pivots. I think bullion might continue to get buying support on declines. And do note the list of my high beta stocks that I shared with you before the expiry of the January series, the link to which I had shared with you last week, and it is still there in the description and the pinned comment below. They are basically oil marketing companies, oil and gas. Do remember that oil and gas has a third largest weightage in the Nifty, and you've seen how HP, BP and IOC have been very, very volatile. They appear in that high MWPL list. I will continue to hunt for outsize or outlier size changes in market-wide position limits in individual stocks, and I'll put them through their paces in our in-house statistical model IBEX for interpretation of more signals. And I wrote in my last 2 weekly live mint articles that the volatility is likely to stay elevated. I remain of the same opinion that volatility might stay elevated in the coming week as well. So I would advise my online family to trade light and stay alert for abrupt trend reversals. Do keep your stop losses in place. As and when I get more trading and investment ideas, I will definitely be sharing it first, foremost and always on our free Telegram channel and then on our other social media accounts. Do make it a point to connect with me there. My contact coordinates come at the fag end of this video. Friends, before I sign off, a reminder to subscribe to our YouTube channel if you haven't already done so. In the comment segment, do let me know how my videos are helping you become better traders. And do help me reach out to a wider audience by sharing my videos with your social media groups, your friends and family members, and help me spread the knowledge-based trading regimen here. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.